So whenever we talk about portfolio management,
Hmm.
the underlying assumption almost always defaults to this kind of directional ambition.
Right, just making the number go up.
Yeah, exactly. You allocate capital, you manage the risk, and your main objective is just to watch the total value of those assets grow over time.
It's all about capital appreciation.
Right. And the metric for success is super straightforward.
Yeah.
Like, did we outperform the benchmark? Did we increase the absolute wealth of the portfolio?
Basically a game of accumulation.
Exactly. It's a game of accumulation.
Which, I mean, that is the reality for the vast majority of retail investors and, well, even a lot of institutional funds,
Sure.
because their goal is open-ended growth. You want the highest possible risk-adjusted return, and you just kind of accept the volatility.
Right. The ups and downs of the equity or high yield debt markets.
Yeah, because your timeline as a regular investor is usually flexible enough to just absorb all that noise.
But, and this is why we're doing this deep dive for you today, there is this entirely different discipline within institutional finance where that whole open-ended growth mandate just completely vanishes.
It's a totally different world.
It really is. We're looking at environments where the objective isn't merely make as much money as possible. The objective is guarantee that a very specific, massive amount of money is available on an exact date in the future.
And that is a huge shift in mindset.
Massive.
Yeah.
Like if you are managing a corporate pension plan or, a life insurance portfolio, your success isn't measured by whether you beat the S&P 500.
No one cares about your alpha in that situation.
Right. It is measured purely by your ability to fund a known liability without fail. Like you owe someone $10 million exactly 5 years from today.
And the market environment between now and then, totally irrelevant to the beneficiary.
Exactly. They just expect the check to clear.
They do. And that paradigm shift fundamentally alters the mathematics of how you even start to construct the portfolio.
You're moving from just asset management to asset liability management.
Precisely. You are no longer trying to maximize return. You are actively trying to minimize the variance of the surplus between your assets and your liability.
Which brings us to the core of what we're unpacking for you today. We are examining the mechanics of liability-driven investing, or LDI, and the equally complex world of index-based fixed income strategies.
Yeah, and our framework for this discussion is drawn from Reading P4 of the Level 3 CFA curriculum.
Right, the 2025 portfolio management materials. And the underlying theme across both of these domains, and you'll see this as we get into it, is just the sheer difficulty of controlling risk.
Especially when the target you're aiming at is constantly moving.
Yes. Whether it's a future liability or a shifting bond index, it doesn't stay still.
And the material really does an exceptional job of stripping away the theoretical elegance of finance.
Oh, for sure. It forces you to confront the real-world friction.
Exactly how interest rate shifts, credit spreads, and honestly just the simple passage of time actively degrade a portfolio's alignment.
So let's start with the absolute foundation here, the most basic mechanism for funding a specific future liability: immunization.
Right. Portfolio immunization.
Conceptually, the idea is to build a portfolio that becomes, well, immune to interest rate fluctuations.
So regardless of whether rates rise or fall, the portfolio compounds to the exact target value.
Right, on the exact target date.
And the premise here relies on treating that future obligation as a single zero-coupon liability.
Meaning you know the exact dollar amount and the exact maturity date. There are no intermediate payouts.
Exactly. And to immunize the portfolio against interest rate risk, the primary mathematical condition, the golden rule here, is that the Macaulay duration of your assets has to perfectly match the due date of the liability.
Okay, let's unpack this a bit for the listener. Why Macaulay duration specifically? Why not just match the final maturity dates of the bonds to the liability date?
It's a great question. Because intuitively, that's what you'd think to do.
Right. If I have a liability due in 10 years, I should just go buy a 10-year bond, right?
Well, if you buy a 10-year zero-coupon bond, then yeah, that works perfectly.
Because there's no coupon payments.
Right. The maturity and the Macaulay duration are identical in that specific case because there is only one cash flow occurring at the very end of the term.
But institutional portfolios aren't usually built entirely out of zero-coupon bonds, are they?
No, almost never. They utilize coupon-paying bonds to build that asset base. And the moment you introduce intermediate cash flows, maturity is no longer an accurate measure of the time horizon.
or its interest rate sensitivity.
Exactly.
Because Macaulay duration is basically calculating the weighted average time until all those cash flows.
Sure.
So the coupons plus the principal are received.
Right. It effectively pulls the time horizon forward.
So if I have a 10-year paying, say, a 5% coupon, its Macaulay duration isn't 10 years.
No, it might be something like 8 or 8.5 years, depending on the current yield environment.
Wow, okay. So if you try to fund a 10-year liability with 10-year coupon-paying bonds, your portfolio's duration is actually too short right out of the gate.
You are mismatched from day one. You've failed the mandate.
That's fascinating. So matching the Macaulay duration to the liability date is critical because it finds that sweet spot.
Yes, it locates the exact fulcrum point where the two primary risks of fixed income investing actually offset each other perfectly.
And those two risks being price risk and reinvestment risk.
Exactly. And they are inversely related.
Let's walk through an example of how that works. Say, interest rates suddenly rise.
Okay, so if rates rise, the immediate impact is negative for the portfolio's market value. Bond prices fall.
Right, so that is your price risk materializing right there.
But because rates are now higher, every single coupon payment you receive from that moment forward can be reinvested at that new higher rate.
Ah, so that's the reinvestment effect working in your favor over time to make up for the price drop.
Precisely. And if rates drop, the whole dynamic just flips.
So the portfolio gets an immediate capital gain because bond prices go up.
Yes, but now you face a drag on your future compounding because those intermediate cash flows are being reinvested at lower yields.
So when the Macaulay duration perfectly matches the liability horizon, you've essentially engineered a state where those two forces completely neutralize each other.
Yes, perfectly neutralize each other by the time the liability is due.
That is incredibly elegant math.
It really is. A rise in rates causes a price drop today, but the higher reinvested coupons perfectly make up for it on the liability date.
And vice versa.
Mm-hmm.
The terminal value of the portfolio stays completely locked.
Locked in. Now, there is a secondary requirement alongside this duration match, which is the funding rule.
Right, the initial market value of the portfolio, so the present value of the assets, has to equal or exceed the present value of the liability.
Because you cannot immunize a deficit.
Right, you can't magically make money appear just by matching duration.
Exactly. The math of immunization only preserves the current economic reality. It ensures a fully funded status remains fully funded.
But if you start underfunded, you just lock in being underfunded.
Right. You will arrive at the liability date short of the required capital, regardless of what interest rates do.
Okay, that makes intuitive sense. You need the base capital for the compounding to actually work. But I really want to spend some time on the third rule outlined in the reading.
Ah, the convexity rule.
Yes, because this fundamentally contradicts standard bond investing wisdom. The text explicitly mandates that to immunize a single liability, you have to minimize convexity.
Yeah, it's a very counterintuitive requirement if your background is mostly in total return mandates.
Right, because in a total return framework, we love convexity. High convexity is celebrated.
Because it gives you an asymmetrical payoff profile.
Exactly. Prices go up more when rates fall than they drop when rates rise.
Yeah.
It's a structural advantage. So wait, why would a manager intentionally strip away that advantage when funding a liability?
Well, to understand why convexity is actually dangerous here, we have to look at how a manager gets high convexity in the real world.
Okay, so how do they build that?
Convexity is a function of the dispersion of cash flows. To maximize convexity while hitting a specific target duration, a manager would use a barbell strategy.
So for a 10-year duration target, they'd buy a heavy weighting of really short-term bonds, like 2-year maturities.
Right, and combine them with very long-term bonds, like 30-year maturities.
So the weighted average hits the 10-year mark, but the actual cash flows are all clustered at the extreme ends of the timeline.
Exactly. And that wide dispersion is what creates high convexity.
Okay, so what's the problem with that?
The problem is that the entire mathematical premise of immunization, that neat offset of price risk and reinvestment risk we just talked about, assumes a parallel shift in the yield curve.
Oh, it assumes the 2-year rate, the 10-year rate, and the 30-year rate all move by the exact same amount at the same time.
Yes, which, as we know, rarely happens in real markets.
Right. Yield curves steepen, they flatten, they invert.
And that structural reality is the fatal vulnerability of the barbell strategy in LDI.
Let's say the yield curve steepens aggressively. Short-term rates drop, but long-term rates rise.
Right. So your 2-year bonds might perform decently, but your 30-year bonds are going to suffer massive price depreciation.
Because the shift wasn't parallel.
Exactly. The carefully engineered balance shatters. Your portfolio's value diverges from the liability's present value. This is structural risk.
So by mandating that the manager minimize convexity, the strategy basically forces them to abandon the barbell approach entirely.
Exactly. By minimizing convexity, you are forcing the manager to concentrate the portfolio's cash flows as tightly as possible around the actual liability date.
So they use a bullet strategy instead.
Yes. If the liability is due in 10 years, you build the portfolio out of 9, 10, and 11-year bonds.
You just smash the dispersion of cash flows down to the absolute minimum.
Right. And when all the cash flows are clustered around that single point on the yield curve, the portfolio becomes largely immune to curve twists.
Because even if the curve steepens dramatically,
Right.
your assets are really only exposed to the 10-year rate environment.
Which is the exact point where your liability resides anyway.
Wow. So minimizing convexity eliminates the structural risk of those non-parallel shifts, destroying the portfolio.
It does. It is a very clear trade-off. You are explicitly sacrificing the upside potential of a highly convex portfolio to buy extreme predictability.
Because predictability is literally the only currency that matters in liability-driven investing.
Absolutely.
But, predictability is challenged by the simple passage of time.
Always.
Because the immunization model we just outlined is really just a snapshot. You match the Macaulay duration on day one, you cluster the cash flows, and it's immunized.
On paper.
Right, on a spreadsheet.
Yeah.
But the next day, the market opens, rates move, and more importantly, time just passes.
The decay of duration is a relentless force. It doesn't stop.
And as time passes, the duration of the assets and the duration of the liability won't necessarily decline at the exact same rate.
No, they rarely do. And as market yields fluctuate, the calculated duration shifts too.
So a month down the line, that perfect alignment we built is just gone. The manager is suddenly facing a duration gap.
Exactly. The portfolio is no longer immunized. It now has directional exposure to interest rates.
Which is exactly what they were trying to avoid. So if the asset duration drifts lower than the liability duration, the manager has to increase the portfolio's duration to close that gap.
Right. And the mechanical way to do that would be to sell short-duration bonds and buy longer-duration bonds in the open market.
But doing that physically on a portfolio that might be measured in the billions of dollars,
True.
that creates massive operational drag.
Massive. The transaction costs alone, the bid-ask spreads, the market impact of moving huge block sizes, it would systematically erode the portfolio's capital base.
You can't physically rebalance a multi-billion-dollar fixed income portfolio every time the duration drifts a tiny bit.
No, the friction would destroy your funding ratio.
Which is where derivatives come into play, specifically using interest rate swaps to synthetically adjust the portfolio.
Swaps really are the lifeblood, the transmission mechanism for LDI strategies. They allow you to tweak sensitivity without liquidating physical securities.
So how does a manager calculate exactly how to close that duration gap using a swap?
They utilize a metric known as basis point value, or BPV.
Okay, and BPV basically shifts the conversation from the abstract idea of years of duration into precise dollar amounts.
Yes. It measures the exact dollar change in the value of the portfolio for a 1 basis point shift in interest rates.
So it totally standardizes the sensitivity.
Exactly. If you calculate the BPV of your liability and the BPV of your current asset portfolio, the difference between them is your duration gap expressed in absolute dollars.
Okay, let's use an example. Say the liability has a BPV of $1.5 million, meaning its present value changes by $1.5 million for every single basis point move.
Right. But due to market drift, let's say your asset portfolio's BTV has fallen to $1.2 million.
So the portfolio is underreacting. You have BTV gap of $300,000.
Yes. You need the asset base to be $300,000 more sensitive per basis point.
And to acquire that extra sensitivity, the manager enters into a receiver interest rate swap.
Right. They agree to receive a fixed rate of interest and pay a floating rate.
Okay, let's walk through the actual mechanics of how the swap delivers that duration, because the swap contract has two legs.
Correct. And each leg carries its own interest rate sensitivity.
The fixed leg of the swap acts like a fixed rate bond. It has substantial duration, so it has a high BPV.
While the floating leg, because its rate resets constantly to match the market, has almost zero duration.
So a very low BPV.
Exactly. And the text provides a formula to find the net sensitivity of the swap. Net swap BPV equals the fixed side BPV minus the floating side BPV.
And the reading uses a standard convention of calculating this per $100 of notional principal, right?
Yes. So in the CFA text example, the fixed side BPV is 0.0825 and the floating side BPV is 0.0075.
Meaning the net BPV of the swap per $100 of notional is 0.0775.
Right. So for every $100 of the swap contract we layer on, we add $0.0775 of interest rate sensitivity.
Okay, so the final step is determining the scale of the trade to completely eliminate our $300,000 gap.
You divide the total BPV gap by the net swap BPV.
Let me do the math here. We take the $300,000 gap and divide it by the swap's sensitivity. But because the 0.0775 is per $100, we adjust the denominator.
Right, effectively dividing $300,000 by 0.000775.
Which results in a required notional principal of roughly $387 million.
Yes.
That is just staggering. It really highlights the sheer scale of the leverage involved here. To adjust the sensitivity by just $300,000 per basis point, you have to execute a derivative contract worth nearly $400 million in notional value.
It is a massive multiplier, but you have to remember the efficiency is undeniable.
Because the manager doesn't actually need to go raise $387 million in cash.
Exactly. They don't need to source those bonds in an illiquid market. They just sign a bilateral agreement.
The physical bonds just sit there untouched, generating their base yield, while the swap overlay acts as this precision dial,
pulling the aggregate duration exactly back into line with the liability.
It's so elegant mathematically. You match Macaulay duration, minimize convexity, correct the drift synthetically. On a spreadsheet, the liability is perfectly contained.
On a spreadsheet?
Yes. Right. But the text spends a lot of time outlining the hidden traps that shatter this architecture in the real world.
Because these models rely on assumptions of correlation that can violently break down under stress.
Yeah. Let's talk about the most prevalent vulnerability, spread risk.
Spread risk. This is a risk born entirely out of the persistent economic pressure to generate higher returns.
Basically, the pressure to avoid being underfunded.
Precisely. See, when an actuary calculates the present value of a future liability, they have to choose a discount rate.
And because obligations like pension payouts are considered highly certain, regulations usually require them to be discounted using a risk-free rate, like government bonds.
Right. And if you discount a large future number by a very low interest rate, the present value of that liability is massive today.
The target the manager needs to hit is incredibly high.
Which presents a huge challenge. If the manager builds the asset portfolio entirely out of those same low-yielding government bonds,
they'll match the discount rate perfectly.
But they will likely require a massive, immediate cash contribution from the corporate sponsor to fully fund it today.
And corporate sponsors generally hate massive cash calls.
They despise them. So the manager tries to close the funding gap by generating a higher yield on the assets. They step out on the risk spectrum.
Meaning they build the immunized portfolio using investment-grade corporate bonds instead of government bonds.
Exactly. They match the duration of the corporate bonds to the liability. The math appears satisfied.
But they've introduced a structural mismatch. The liability is reacting to changes in government yields, while the assets are reacting to corporate yields.
And the spread between those two yields is the credit risk premium, which is definitely not static.
Right. What's fascinating here is what happens during a severe credit event.
Oh, it gets ugly. Say there's a systemic panic. Investors panic and flood into government bonds in a flight to quality.
So government bond prices skyrocket, meaning government yields plummet.
Right. Now, from the perspective of the liability, this is a worst-case scenario. Because the liability is discounted at government rates, a plummeting government yield causes the present value of the liability to soar.
The target just moved substantially higher.
Yes. But look at the asset portfolio. It's holding corporate bonds. During a panic, investors are terrified of corporate defaults.
So they demand a much higher premium. Corporate spreads widen aggressively.
And the yield on corporate bonds spikes, even as government yields are falling.
Wow. So when corporate yields spike, the market value of the corporate bonds in the portfolio plummets.
Exactly. The immunization fails catastrophically. The portfolio's asset value is collapsing at the exact same moment. The liability's present value is soaring.
You are instantly massively underfunded, despite matching the Macaulay duration on day one.
Because duration matching only immunizes against parallel shifts in the specific yield curve you are benchmarked against. It offers zero protection against the spread between different curves blowing out.
That is such a huge trap. It's the cost of reaching for yield in LDI.
There is no free lunch in finance.
No, there isn't. Okay, the second trap the material details is convexity error. Now, we discussed how managers try to minimize convexity using bullet portfolios.
Right, but even a bullet portfolio has some degree of convexity. Bonds inherently possess convex price-yield relationship.
The duration is just a linear approximation, right? Draws a straight line against the curved price-yield profile.
Exactly. Now, for small movements in interest rates, a few basis points up or down, that straight line is incredibly close to the actual curve.
So the duration metric works great for small shifts.
But as the magnitude of the rate shock increases, the straight line of duration diverges significantly from the actual convex price curve.
The estimation error compounds.
Yes. If a market experiences a sudden rate shock of, say, 150 basis points, relying purely on linear duration will yield severely inaccurate results.
The manager might look at their screen and believe the assets and liabilities are moving in tandem.
But the underlying convexity differences mean their actual market values are rapidly drifting apart. The model breaks down at the extremes.
That is terrifying. And the final trap is asset liquidity risk. This really hits on the practical limitations of managing physical bonds.
We noted that managers use swaps to avoid trading friction, but swaps only adjust the interest rate sensitivity.
They don't change the actual bond sitting in the portfolio.
Right, and eventually physical bonds mature, or their credit ratings are downgraded and they violate the investment mandate.
Meaning the manager is forced to sell them and reinvest the capital.
But the spreadsheets assume these assets can be easily liquidated at their current mark-to-market prices.
Which is a total illusion in stressed fixed income markets.
Completely. Unlike large-cap equities, where liquidity is deep, corporate bonds often trade by appointment.
If the portfolio holds complex structured products or bonds from distressed issuers, the bids might just disappear entirely.
And if the manager is forced to liquidate to meet a cash call, they face punitive haircuts. The act of selling the asset destroys the value that was recorded on the balance sheet just a day prior.
So liquidity risk is this phantom variable that is totally invisible right up until the moment you desperately need flexibility.
Exactly. So LDI, despite its name, is an intensely active management process masquerading as passive matching.
You're constantly calculating gaps, overlaying swaps, monitoring spreads, just to keep the portfolio standing still.
It's exhausting just to think about.
It really is. Now, the second half of Reading P4 shifts focus to strategies that are explicitly mandated to be passive, index-based investing.
Where the objective shifts from funding a specific liability to perfectly tracking a stated benchmark.
And the assumption for most people listening is probably that passive indexing is a solved problem. I mean, in the equity space, it's easy.
Oh, very easy. A manager tracking the S&P 500 simply buys the 500 stocks in their market cap weights.
The friction is minimal. The tracking error is practically zero. You just buy and hold.
But applying that same passive philosophy to the fixed income market introduces monumental structural challenges.
Right. The goal is the same. Minimize tracking error.
Right.
Or active risk, basically the standard deviation of the active return.
You want the difference between your portfolio's return and the index's return to be exactly zero.
Any deviation, whether you underperform or outperform, is a failure.
But the difficulty comes from the nature of the assets themselves. Equity indexes are basically static. Companies stay in them for decades.
It's like an equity index is a curated museum collection. You add a painting, you take one down, but mostly it stays the same.
Exactly. But a bond index is inherently ephemeral.
It's like the produce section at a grocery store. Everything is constantly aging, expiring, and being replaced.
That's a great analogy. Every single bond in the index has a finite lifespan. As each day passes, the duration of every bond is steadily declining.
So the risk profile of the assets is constantly decaying.
If the index provider did nothing, the aggregate duration of an intermediate bond index would just bleed down to zero as the bonds mature.
But index providers don't do nothing. They maintain specific maturity bands through a reconstitution process.
Typically at the end of every month, they eject the bonds that have aged out of the window and replace them with newly issued bonds.
Which creates a huge nightmare for the passive manager.
It really does. Imagine you build a physical portfolio that perfectly replicates the index today. Over the month, your portfolio's duration decays alongside the index.
You're perfectly in sync.
But on the last day of the month, the index provider drops the short bonds and adds billions of dollars of newly issued long-duration bonds.
The index's duration artificially snaps back up to its target level.
And you, the manager, who has executed exactly zero trades, are suddenly misaligned.
Your portfolio duration is now too short. Your tracking error explodes.
So to maintain the passive mandate, you are forced to actively trade. You have to sell your aging bonds and buy the new issuances just to match the reconstituted benchmark.
You're trapped in this state of continuous forced turnover just to stay still. And the complexity is compounded by the sheer size of these indexes.
Oh, yeah. Broad market bond indexes contain tens of thousands of individual securities.
And a lot of them suffer from those exact liquidity issues we just talked about. They might not trade for weeks.
Which makes it practically impossible to fully replicate the index physically. You simply cannot source all the underlying securities.
So what do? They have to rely on sampling, right?
Yes. They construct a smaller, more liquid sub-portfolio that is mathematically engineered to mimic the behavior of the massive index.
And the text details some really advanced tactics required to do this without causing tracking error to blow up.
You have to isolate and match specific risk factors, the most fundamental being modified duration.
Okay, so matching modified duration minimizes tracking error due to parallel shifts in the yield curve.
Right. It isolates the portfolio's price sensitivity to uniform rate movements.
But, as we established earlier, yield curves rarely move in parallel.
Exactly. If you only match modified duration, your sampled portfolio will diverge from the index the moment the yield curve twists.
So, to manage that structural risk,
Yeah.
the sampling process has to incorporate key rate duration matching.
Yes. Key rate duration is like a surgeon's scalpel compared to the blunt instrument of modified duration.
It isolates the sensitivity at specific maturity points
Right.
along the curve.
Exactly. The manager analyzes the index and determines its exact exposure to the 2-year rate, the 5-year rate, the 10-year rate, entirely independently.
Then they build their sampled portfolio to perfectly match those specific nodal exposures.
So if the yield curve steepens aggressively, the sampled portfolio reacts identically to the full index.
Because the localized sensitivities are perfectly matched, key rate duration defends against non-parallel twists.
Exactly. But interest rate risk is only half the battle. When sampling a corporate bond index, you also have to manage credit exposure.
Right, you can't just match the average credit rating of the index. You have to control for idiosyncratic event risk.
Which means matching issuer exposure weights. This is crucial.
Let's apply this conceptually. If a broad index contains thousands of corporate issuers, the sampling manager obviously holds fewer names.
Right. They might decide to hold debt from General Motors, but skip holding debt from Ford.
Assuming the broad automotive sector exposure is basically the same.
And in a normalized environment, that substitution might track perfectly. The yields of the two automakers are usually highly correlated.
But the manager has just introduced specific event risk.
Say, Ford unexpectedly announces a massive restructuring or files for bankruptcy.
The bonds gap down violently, and the broad index, which held, say, a 2% weighting in Ford, suffers a corresponding drop in its total return.
But the sampled portfolio didn't hold Ford. It bypassed the bankruptcy entirely.
So the portfolio avoids the loss. Now, in a total return framework, the manager looks like an absolute genius.
But in a passive indexing framework, the manager has objectively failed.
Because the tracking error just spiked massively.
Yes, having a highly positive active return proves you are taking on active risk relative to the benchmark.
To avoid this, the sampling must rigidly adhere to issuer weights. If an issuer is a notable percentage of the index, you have to hold that exact percentage.
You have to deliberately capture the idiosyncratic risk so that if a company defaults, your portfolio suffers the exact same localized damage as the benchmark.
Wow. The operational burden of doing all this, physically balancing key rates, replicating issuer weights, constantly fighting duration decay, sounds like a nightmare.
It is a massive operational lift, which brings us to the alternative strategy for index replication highlighted in the text, the total return swap, or TRS.
The ultimate synthetic shortcut.
Exactly. It bypasses the friction of physical replication entirely.
So rather than attempting to sample thousands of illiquid bonds, the manager just enters into a derivative contract with a major counterparty, like an investment bank.
And the mechanics here are very distinct from the interest rate swaps we discussed earlier for LDI.
Right, an interest rate swap only exchanges the rate components, but a total return swap exchanges the entire economic reality of the reference asset.
The receiver in a TRS gets both the income generated by the index and any capital appreciation.
So if I want to perfectly track the Bloomberg U.S. Aggregate Bond Index, I structure a TRS where the bank pays me the exact total return of that index every month.
Yes, if the index generates 2% in coupon income and gains 1% in price, the counterparty pays you 3%.
Tracking error is basically zero. The passive mandate is achieved flawlessly.
On paper, yes, but of course you have to pay for this performance.
Nothing is free. The payer leg of the swap represents the financing cost. The manager pays a short-term market reference rate, like SOFR, plus a negotiated spread.
And that spread is determined by the bank's balance sheet capacity, the liquidity of the index, the creditworthiness of your fund.
So by using a TRS, the manager is basically trading all the operational headaches of physical sampling, the trading costs, the liquidity constraints, for an entirely different category of risk.
Systemic counterparty risk.
Right. Your fund's ability to deliver the index return is now entirely dependent on the solvency of that single investment bank.
If the market experiences a severe shock and the counterparty defaults, the swap contract just vaporizes.
You're left holding your collateral, but your perfect index replication is broken.
It's a huge concentration of risk. But there is an even more brutal mechanical reality to the TRS that the text points out.
Oh, the negative returns. This is the part that really underscores the leverage inherent in synthetic replication.
Yes, because if a manager is running a physical bond fund and the market drops by 5%, the net asset value of the fund simply declines by 5%.
Right. It's just a paper loss.
Right.
No capital actually leaves the fund's accounts. The assets are just marked lower.
But a total return swap is a contract for the exchange of cash flows. The receiver is entitled to the total return of the index.
Wait, so if that total return is negative, meaning the index tanks, I actually have to pay my counterparty the amount the index lost.
Yes, the math is absolute. If the index drops 5%, you, the manager, must physically transfer cash equal to 5% of the notional principal to the bank to cover their loss.
Because the bank probably hedged their exposure in the physical market and suffered real losses they need to fund.
Exactly. And on top of paying that negative return, you still owe the financing leg of the swap.
Oh, wow. So I'm paying the 5% loss plus the SOFR rate plus the spread.
Yes. It creates a severe liquidity drain during market downturns.
The fund has to keep massive cash reserves just to meet these margin calls.
And if the market drops violently and you exhaust those cash buffers, you fail the margin call. The counterparty will terminate the contract.
Which crystallizes your losses at the absolute bottom of the market. And your exposure is severed precisely when you need it most to capture any recovery.
The elegance of the TRS on the upside really masks a violent liquidity requirement on the downside.
It's the ultimate double-edged sword. And this is a recurring theme throughout reading P4, isn't it? Institutional fixed income management is really just a constant exercise in risk transformation.
That's a perfect way to put it. You never truly eliminate risk. You just package it into a different format that you think you can manage better.
Right. You use Macaulay duration to eliminate interest rate variance, but you expose yourself to yield curve twists.
You minimize convexity to protect against those twists, but you sacrifice structural upside.
You step out into corporate credit to solve funding deficits, but you absorb spread risk.
You use a TRS to perfectly replicate an index, but you take on concentrated counterparty and liquidity risk.
Every tactical solution just introduces a new systemic vulnerability. And as we wrap up this deep dive, I want to pivot back to the dynamics of the indexes themselves for you listening, because we discussed how index providers reconstitute benchmarks based on new bond issuance, right?
Yes, the monthly rebalancing.
And the passive managers are structurally obligated to follow the index, no matter what it contains.
The index dictates the manager's portfolio. Absolutely.
But the composition of the index is dictated by the borrowers.
Yes. And this is the ultimate structural irony of passive fixed income investing.
Because corporate and government issuers determine the terms of the debt they bring to market. They optimize based on their own needs.
Think about it. If a corporate treasurer sees that long-term interest rates are historically low, they will logically want to lock in that cheap financing for as long as possible.
So they issue massive volumes of 30-year bonds. The primary market floods with long-duration debt.
And because broad bond indexes are market value weighted, all of those newly issued 30-year bonds are just absorbed straight into the index,
Mechanically stretching out the aggregate duration of the index. The benchmark becomes significantly more sensitive to future rate hikes.
And the passive funds, bound by their mandate, have no choice but to adjust their samplings or their swap overlays to reflect this new, longer duration.
They are forced to take on more interest rate risk, simply because corporate treasurers decided it was a good time to borrow long-term.
So the passive investors who allocated capital seeking a stable risk profile suddenly find themselves holding a highly volatile, long-duration portfolio.
The risk profile morphed entirely independent of their objective.
It raises a profound question. Trillions of dollars are locked in passive fixed income mandates. The managers of that capital must blindly mirror the benchmark.
So the entity is actually determining the risk parameters of that massive pool of capital, aren't the asset managers. And they aren't the investors.
Consider this. The entities dictating the risk are the borrowers. Merely by shifting their issuance between short-term paper and long-term bonds, issuers actively force the hand of the entire passive complex.
They dictate the duration, the credit exposure, the systemic sensitivity, who is really following who.
When the volume of passive capital gets this big, the traditional relationship is inverted. The borrower is effectively architecting the portfolio of the lender.
The tail wagging the multi-trillion-dollar dog. What a sobering realization of how index rules quietly govern global risk. We have covered an immense amount of ground today, from single liability immunization to the chaotic reality of index replication. For you listening, thank you for joining us on this extensive deep dive into the hidden architecture of institutional finance. Keep examining the mechanics, keep questioning the models, and we will see you next time.